members of the Institute of Cost Accountants of India, honored guests, ladies and gentlemen. It's really a great honor for me to be here this morning or this afternoon to talk to you about boardroom governance for value creation. Now, before I actually get into boardroom governance, I'm going to talk a little bit about value creation. And the reason I'm doing this is because I want to make it more relevant to members of your institute, because from now on it's about where the rubber hits the road. We've been talking about objectives, but what should we be doing to make sure that these objectives are actually achieved? I'm going to start with a little bit of a history of corporate reporting. And we all remember the corporate collapses that took place at the beginning of the century, and you remember those names there. Now, the interesting thing about this is that in none of those corporate reports was there any indication that these organizations were going to fail. Then we fast forward to the global financial crisis, 2008. And again, there was no indication that these organizations were going to fail in their annual reports. However, there was a lot of information about it in the media, and we knew that we were in the midst of a financial bubble which was going to burst at some stage. Another interesting thing was that if you looked at annual reports of organizations from around the world from 1950 to 2010, you could see them getting thicker and thicker and thicker. Back in 1950, they might only be a few pages, but by 2010, I saw some reports that were over 500 pages in length. You can't read 500 pages and assess an organization. Now, you might have seen this graph before. I find it very interesting. It shows the S&P 500 market value components, and it splits them, the value of all the shares included in that index, splits it between tangible and intangible assets. And you can see back in 1975, 83% of the value was underpinned by tangible assets. But fast forward to 2015, and what do we see? It's only 16%. 16%, and 84% is intangible of the value. Now, that tells us that there's something happening. And that means that financial information isn't as important as it used to be. Yes, it's important, but there are other factors that are happening. And what you found was that organizations were beginning to build into their annual reports things like strategy, risk and opportunities, governance, etc., because that was necessary to be able to understand the organization and where it was going. So PwC came out with a report in 2010 saying that corporate reporting was lengthy, uncoordinated, impossible to understand, and that was in fact the elephant in the room. Corporate reporting wasn't causing the collapses, but it wasn't contributing in the way that it should. This was of major concern to regulators, to standard setters, lawmakers around the world, and we saw a raft of new regulation, laws, and so on, standards put into place. But that didn't really help too much. Might have plugged a few holes, but in fact, corporate reporting was not doing what it should do. And the Prince of Wales, on an annual basis, invites businessmen and professionals from around the world to attend a conference at St. James Palace. This is an annual thing. In 2010, the people that attended that conference decided enough is enough. We need a new corporate reporting framework. And they formed an organization which became known as the International Integrated Reporting Council. Now, they appointed a working group in early 2010 to 2011, and I was fortunate enough to be one of those members of that working group. And they labored for 3 years, consulting with people around the world, and they put out various discussion papers, and eventually came out with the International Integrated Reporting Framework, which was published in 2013, December 2013. That framework today is used by over 2,000 global companies as a basis for their reports. It is now mandatory in some countries, and it's encouraged by stock exchanges in a number of countries. It's also the concepts are included in the frameworks of a number of countries around the world. So what is an integrated report? Firstly, it's a concise communication, which is better than the 500 pages we had before. It's about how an organization's strategy, governance, and performance and prospects, which are the sort of things that were being added into these annual reports to try and improve them, in the context of the external environment. Now, if you want to understand strategy, you need to know what the external environment is doing. And then it goes on to say, lead to the creation of value in the short, medium, and long term. So financial statements look backwards, but integrated reporting is about the future. Integrated reporting is based on two fundamental concepts, and you will guess the first one is value creation. The second one, the capitals that the organization uses to create value. Let's look at value creation. Who does the organization create value for? Well, obviously it creates value for itself, but it can't create value unless it works with its stakeholders. If it doesn't create value for its customers, it doesn't have a business. If it doesn't create value for its shareholders, it doesn't have finance. If it doesn't create value for employees, you're going to run into problems. The beauty of integrated reporting is that it applies equally to private sector, public sector, not-for-profits, and organizations of any size. The capitals. As accountants, we all know about financial capital. But there are other forms of capital that organizations use. Manufactured capital, which would be your tangible assets, your buildings, your plant and machinery, etc. Human capital, intellectual capital, and by that we mean things like brands, research and development, intellectual property, competitive processes. And then social and relationship capital. I said that the organization needed to work with its stakeholders to create value. And therefore, those relationships with those stakeholders are a form of capital that the organizations use. And in many organizations today, they recognize that. Finally, natural capital. And if you think about that, organizations consume water, they emit greenhouse gases, etc. So natural capital is something that is affected by the organization, but if it's fishing or if it's mining or it's operating on land, it's also consuming resources. So in summary, an integrated report explains how an organization creates value over time. Value is not created by or within the organization alone. It's influenced by external factors, and we're talking about political, social, economic, technological factors. It's created through relationships with stakeholders, and it's dependent on resources, the 6 capitals that I mentioned earlier on. Now, when we started work on this framework, integrated report, we realized that the integrated report only comes at the end of the year. And if the organization doesn't operate in an integrated way, it's very, very difficult to put together a credible integrated report where the financial and non-financial information come together. So there was a missing ingredient, and that missing ingredient became known as integrated thinking. Organizations need to operate in an integrated way if you are going to be able to produce an integrated report. But there was still a gap because there's board and management reporting. And that needs to be integrated as well. That's part of integrated reporting. And that's where CMAs play such an important role. And also understanding that it's not only financial information, it's information about all of those capitals that are necessary for management to make decisions and also necessary for boards to make decisions. So what is integrated thinking? Firstly, it's the active consideration by an organization of the relationships between its various operating and functional units. That's operational integration. But it goes further than that. And the capitals that the organization uses and affects. It continues to say integrated thinking leads to integrated decision-making and actions that consider the creation of value over the short, medium, and long term. So we've moved away from profit to one of value creation value creation not only for the organization, but also for its key stakeholders, including the community. So what's the relevance of this, and how should the board support and govern value creation? I've used as the basis for this the King report, which came out in South Africa in 2016, was issued by the King Committee, chaired by Professor Mervyn King. And this was hailed internationally as a leader in corporate governance. And I'm going to use those principles to hang on those principles to show you how governance should oversee value creation. If you're interested in this particular King Code, you can download the code from that web address, which is at the bottom of that slide. Now, Professor Mervyn King happens also to be, or at the time was the chairman of the International Integrated Reporting Council and the former chairman of the GRI as well. And in describing this, the King Code, he said, the overarching objective of King 4 is to be the catalyst for a shift from compliance-based mindset to one that sees corporate governance as a lever for value creation. As a lever for value creation. Okay, so it's a move from being a passive board to be an active board. The fundamental concepts on which it is based: sustainable development, integrated thinking, which we've been talking about, organizations as an integral part of society, corporate citizenship, stakeholder inclusivity, and integrated reporting. Now, we've been talking about the Sustainable Development Goals, and we live in a world, as we've been talking about, which is running out of resources and is also beset by huge issues that boards need to understand that they cannot just operate on their own in a vacuum. They need to understand what the Sustainable Development Goals, what it means for the organizations if they want to achieve value creation. Now, King 4 includes 17 principles. I'm not going to go through all of those 17. We don't have time. I'm going to just dwell on some of the more important ones. And the first one being composition of the board, which is critical. And this, if you look at the bottom right-hand corner of that slide, you'll see which principle it is. And it says that the board should be comprised of the appropriate balance of knowledge, skills, experience, diversity, and independence for to discharge its governance role. Now, if we look at boards around the world, we often see that there isn't a single woman on the board. And women bring a tremendous amount of acumen to boards. If we look at the composition of boards, you often see clones of each other, people that have the same kind of background. They seem to be very clubby. In this day and age, with so many issues facing us, how can boards not be put together with the kind of skills that are necessary to create value? And boards really, and you just look at them and you say, well, that board can't create value for this organization. It really is something that one needs to look at to improve the composition of the board, to make sure that the right skills, diversity, and so on are there. But I'd go further than that. I think members of the board also need to understand what value creation is and its relationship to the capitals. Because if you're only driven by financial issues, you're never going to be able to create value on a sustainable basis. The next principle is ethical leadership and culture. And we will all say, great, yes, we need to be ethical. It's a very important issue. But you know, I look at corporate failures around the world, and particularly those in South Africa of late, the last 5 or 10 years. And in every single case, there's been unethical behavior, corruption, fraud, etc. And you know, in today's world, with social media, with whistleblowers, with intensive regulation, it's going to be picked up at some stage. It's going to be picked up at some stage. And so you might make profits over the short term, but eventually it's going to affect the organization. And it's going to come back to the board. The board are going to be held responsible for what is happening. And it's no excuse to say we didn't know what was going on. And that's why boards need to be active in looking at strategy, in looking at the ethical leadership, or the ethics of the organization, and embedding a culture of ethics in the organization. Then the concept of a responsible corporate citizen. The board should ensure that the organization is and is seen to be a responsible corporate citizen. Organizations are corporate citizens. They're citizens, they benefit from the services that are provided, they consume resources, and they have responsibilities and obligations. But it goes further. It goes on to say they should ensure that the organization's culture and ethics and values are reflected in its use of and effects on the capitals. Now, obviously, it applies to environmental or natural capital, the way that you deal with water consumption, etc., etc. But it applies to all of the capitals, how you deal with your staff, etc. I said that organizations can't create value unless they work with their stakeholders. And King 4 says, the board should adopt a stakeholder-inclusive approach that balances the needs and interests and expectations of the material stakeholders in the best interests of the organization over time. Stakeholders are so important to the organization, and I look at reports that come out from companies, how they engage with their stakeholders, and I wonder how they can actually get information from them, because information that your customers hold, information that your employees hold, can be incredibly useful to the organization in shaping its strategy, identifying its risks and opportunities. So let's talk about the value creation. What does King 4 say about it? Well, it says that the board should appreciate that the organization's core purpose, its risks and opportunities, its strategy, its business model, performance, and sustainable development are inseparable elements of the value creation process. So, what do we mean by this? Well, many organizations today do things to combat the sustainable development goals, but it goes much further than that. Take the fishing industry, for example. If the fishing company fishes out the stocks of fish, it doesn't have a future. That's a very simple example. But all organizations are affected by the Sustainable Development Goals. And it's not just a matter of contributing towards them. It's a matter of building them into the strategy of the organization, depending on what industry that they're involved in. And I've been working with a number of banks in South Africa to try and convince them it's not only the risks of the Sustainable Development Goals, but as we heard earlier on, it's also about opportunities that they provide for organizations. So it's not just contributing, it's actually embedding it into the strategy of the organization, which is so, so important if we're going to get there, but also from a value creation point of view. If the organization wants to create value, then it needs to take these opportunities that exist out there in the marketplace. So talking about strategy and risk, and this is particularly important, the board should actively influence and monitor strategic direction for the short, medium, and long term. They need to actively involve, not just a passive acceptance of what management suggests the strategy should be, but even more important, it should ensure adequate resources are accumulated to implement strategy in the short, medium, and long term. How often do we hear that it wasn't the strategy that was ineffective, it was that it was the implementation of the strategy that didn't work. That's where the shortcomings came. And if you want to implement strategy, you need to make sure that you've accumulated the resources to be able to implement it on a short, medium, and long-term basis. And you need to accumulate those resources over time. And what worries me about this 5 trillion by 2024 is, are there actually, and we heard this yesterday, do we actually have the resources, do we have the infrastructure to put it in place? Because in my country, we've had several economic development programs that have been listed or notified, And none of them have actually worked because nobody has actually put in place the resources to do it. And it's the same in a company. It's so important to have the resources, to build the resources, to implement that strategy. And then overseeing risk management. Very important for the board, not just to accept the processes that are in the organization to identify risks, because risks can come from anywhere. They can be in the supply chain. And I'm noticing now that boards in South Africa, a number of them, where the board actually does its own risk analysis to see whether that the companies actually are dealing with all of the risks that are critical to the organization. And I'll just remind you of a scandal, 2001, the Nike scandal, where they were using underage children in sweatshops to manufacture goods, or that they were buying from organizations that were producing their goods. It's well known, and obviously Nike has addressed this and is well back on course. But there's so much of this happening around us. I was reading last week about hotel chains, major hotel chains, which are part of human trafficking. Whether they know it or not, I don't know. But a lot of human trafficking takes place through hotels around the world. In the fishing industry, the same. Human trafficking, use of underage people. There are many industries where these things are taking place. And if the board of directors don't know that it's taking place, they should know about it, and they should be inquiring about what's going on, because it's going to eventually become a public scandal, and when it does, the share value is going to decline massively. Technology and information. I don't really have to talk about technology in India because India is a leading country developing technology. But it's so important to boards. And King IV says the board should govern technology and information in a way that supports the organization in setting and achieving of its strategic objectives, and it should promote and support innovation. Innovation is the lifeblood of the organization. If it's not constantly innovating, it's going to face competition and might well go out of business. But from a technology point of view, if you think of the banking industry, and I can just think of in South Africa how banking has changed over the last decade or so, moving away from the branch system to internet banking, to cell phone banking, and if one looks into the future with blockchain, artificial intelligence, and cryptocurrencies and so on, the world is changing dramatically. But those are the opportunities, but they're also the risks. What do you do with the people that worked in the branches in the past? They've got to be retrained to be able to adapt to these changes, and maybe they can't be. So you've got a very difficult situation of dealing with employees, etc. So these are just some of the kinds of things that technology can influence. But the board can't or shouldn't just accept what management is saying. They need to be proactive in dealing with these issues and making sure that they are dealt with in an appropriate way. Then remuneration and incentives. King IV says the organization should remunerate fairly, responsibly, and transparently so as to promote the achievement of strategic objectives. Very important, but the IR framework goes even further. It says remuneration and incentives should be linked to value creation in the short, medium, and long term, including the organization's use of and effects on the capitals. How many organizations only use the financial outcomes for working out the remuneration and incentives, especially of the executive staff? And if you do that, you're going to be driving strategies that may be short-term based or are not actually driving value creation. If you are serious about value creation, you need to remunerate based on value creation. And then finally, reporting to stakeholders, a very important aspect of the governance role, reporting to your stakeholders. And the board should ensure that reports are issued by the organization that enable stakeholders to make informed assessments of the organization's performance and its short, medium, and long-term prospects. And it goes on to say that it should issue an annual integrated report. Now, we started with integrated reporting and we're ending with integrated reporting. You can see how important those concepts are within the organization. And certainly from the point of view of CMAs, it's important for them to understand, or for you to understand, that reporting, integrated reporting is not only the annual report, it's also reporting to management and to the board. And I think it's also, I'd like to just leave you with, that boards need, this is what Professor Mervyn King said about King 4, boards need to shift from a compliance-based mindset to one that sees corporate governance as a lever for value creation. Boards need to be active and involved in what's going on in the organization, and they need to be balanced. Thank you very much.